In this video, guys, we're going to look at characteristics of a trend day versus an extreme move that's liable to retrace. Stick around for this one. Hey traders, warm welcome to you. So we've got two different things. We could say, okay, well, the market has gone from 10 to 50. The market has gone from 10 to 50. Two same movements, but they can do it in completely different ways, and we can have completely different trading opportunities. So for me, the difference is between a trend day and an extreme move that's liable to retrace. And what I mean by extreme move that's liable to retrace is something that is spiking aggressively, perhaps has got two-way flow, offers opportunity to fade those extremes, pull back to mean, scalps them out, look for an extension again, versus a trend day, which is chug, 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 chug. You start trying to short a trend day, you're going to get run over. You start trying to buy an extreme move type day, you might get run over by a counter trend pullback that then takes out the high, whips you out. So you've got to have a way of deciding which is which and using the right strategy or the right tool for the job. Okay, so the first thing to look at, guys, is the angle. So what's the angle like of the move? A chugging trend day is going to be relatively at a 45-degree angle almost, or something like that. It's not going to be very, very steep. In other words, it's going to be chugging, chugging, chugging like this. That's going to be a trend day, very steady, chug, chug, chug. However, extreme move liable to reverse is going to be this, spiking aggressively, very sharp angle, which cannot be sustained and will want to pull back. So you might get a sharp angle that kind of pulls back viciously, and a sharp angle that pulls back. And now you can see we're kind of almost at the same place as we would be if we're chugging, but we've got there very, very differently. And so look at the angle, guys. If it's a sort of shallow angle, it's chugging, then start to put it into the trend category. If it's sharp angle, then start to put it into the, hey, be careful about chasing it, look for retracements. Shorts may be still okay if I'm quick on it. Volume is the other one. If we're trading something where you can look at volume, the volume will be intermittent, i.e. you have pulses of big volume coming on these spikes on this type of thing, and you have maybe dying volume, pulses of volume increasing, decreasing, increasing, decreasing. A trend type day, very consistent volume, plod, 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 because the algos are slicing the orders up over the volume period, over the time period, so you're getting very steady volume. You might get a little bit of a pickup at the open, at the close, but generally speaking, you've got that slow volume rather than spikes through levels, calms down, spikes, that sporadic staccato type movement. Number 3, candle lengths. Similar to volume, in terms of trend day will have very consistent, calm candle lengths. They'll almost be identical, chugging along, plodding up. It's almost a symmetry to it. The volume's symmetrical, the candles are within a certain range. You might get a little bit extreme one, but rather than retracing, it'll just sit there and wait, then it'll plod on again and plod on again. Whereas this kind of erratic movement, or this extreme move liable to retrace, you'll get big extremes. You might get a massive candle, then a couple of small little dojis, and then you might get a kind of one's the downside, one's the upside, very mixed in length, much more akin to day trading, or even if you look at a swing trading perspective, much more able to get on and notice the differences between shifts in momentum and supply and demand and swing levels, etc., as opposed to the plodding day. So watch out for your candle lengths, guys. Number 4, pullback depths. Pretty obvious one. You guys know this one, but I put it in here. Trend hardly pull back much. You might get a slow counter trend that chugs down and takes its time and rolls back up again, which is fine. There's a nice setup based on that. But these are kind of vicious ones, these extreme moves that are liable to retrace, have those big spikes, they retrace aggressively and they go again. And the pullbacks are much bigger. So if you're getting bigger, deeper pullbacks, you need to be kind of looking at trades around that as opposed to trying to plodding on for the trend day type thing. Number 5 is the wicks and tails, similar to candle lengths, but of course, it's the sharp direction changes that give it the criteria or give it the characteristic of this. And even on a broad basis and on a short basis, so intra-candle, 5-minute candle, massive spike up, pulls down, closes at lows, big wick left there, sends the downside, big tail left there, solid candle the next one, etc., etc. Trend day, Smaller candles, you're not going to get very many wicks on it. Yes, you may well do, of course, but generally the body's going to be reasonably solid as it kind of plods along, goes up, closes, starts again, plods, closes. It's a much slower movement to it. You're not waiting to try and capture extreme moves that are only there for a few seconds or a few minutes. The move is trading at a level for a longer period of time before it's plodding on. And the final thing, guys, are the markets. If you're looking at a chart here and other markets are all trending up, like say we're in the indices and all of the indices are trending up, chugging along, then you know you're in a trending environment. If other markets are not doing much, but this one's going crazy, then you know there's some two-way trade to it. So what's the point of deciphering between the two? Well, the point is, guys, that you can open up different types of trading strategy depending on the conditions you're in. Trending environment, you want to be waiting for a longer cycle lower to some kind of mean, some kind of moving average, some kind of VWAP before trading it. Or you're buying fresh highs because it's chugging, it's chugging, it's chugging, it's plodding. It's not my thing, but I know people that do that and it works very well for them because the market just chugs on and on and on and on. And they hold it to the close. It's very profitable. You start buying fresh highs in this kind of thing, you're going to get whipped because it's going to come down, it's going to stop you out and ping again. So you can trade a little bit more, waiting for market to stretch to the downside for it to ping back up. You can trade extensions to the upside. You can trade almost mean reversion within a trending environment, or you can just stick to the long side and trade kind of mean reversion but aligned with the trend. So it's a distinct different strategy. So it pays to kind of run through a checklist or any other things that you guys have got and stick it in the comment section below that you guys want to point out on this, so that you can use the right tool for the job, so you don't get caught out. Because too many times, guys, we see that we're trying to buying highs thinking this is a trend and it gets whipped, or we're waiting to buy on a pullback here and the limit just sits there and the thing just plods on and on and on, and we're waiting for too much of a pullback, or we're waiting for this, or we're waiting for that. And so distinct different environments, looking at the characteristics, categorizing them, using the right tool for the job helps us out as traders a lot. All right, guys, whatever you're doing, take care, and I'll see you in the next video. Bye-bye.